Okay. Um, okay, welcome everyone. So today this is a new session on for AI for good. So today I thought I'll be talking about AI and sustainable investing, and I'll describe what it is about exactly. So very recently, we have followed the news. The COP28 has just concluded in Dubai. So these were meetings regarding how the world is addressing climate change, and AI has been mentioned, of course, during these events. So here it's a very particular angle, how we can invest and have a positive impact on climate change, for instance, using AI. But AI can obviously be used for other things, right, to address climate change directly. And we had a few sessions about this before. So we'll take questions at the end of the presentation, but I'll take half an hour, 30 minutes, 40 minutes to discuss about it, and we can engage in Q&A. First, sustainable investing. So what is it about? So the Chicago economist Milton Friedman in 1970 said the following. So this is the quote: "In free enterprise, private property system, a corporate executive is an employee of the owners of the business. He has direct responsibility to his employers. That responsibility is to conduct the business in accordance with their desires. The key point is that in his capacity as a corporate executive, the manager is the agent of the individuals who own the corporation, and his primary responsibility is to them." What he means that the responsibility of the CEO is to his shareholders, and to the extent that they care about the share value, the economic value of their shares. So their job is really to maximize the stock price. More recently, so this was in 1970, right? It's like so more than 50 years ago. So a lot of things has been done before since then. And so another Chicago economist, Luigi Zangales, and his co-author Oliver Hart, very recently in 2022, cited the examples of shareholders pressuring companies to disclose their environmental impact, asking companies to align their lobbying activities with climate goals. And so this was 2022, right? So, and protect workers' rights during COVID-19. So this is shareholder activism. So challenges the Milton Friedman's view that we call the traditional corporate governance paradigm, and signal a shift from shareholder value maximization to something that they call shareholder welfare maximization. Right, so the welfare of the shareholders. So it means that it's not only their wealth, but it could be other objectives, right? So these shareholder welfare maximization will include both financial and social considerations. Okay. So this is like a graph on in Google Trend. Look at the interest in sustainable investing over time, that you see that has increased a lot since the 2013. So the principle of responsibility investing investment has been summarized by an organization called the PRI. And that institute has collected these 6 principles, and many companies, organizations have signed up to have committed to follow these principles. So they are the following. So first, we will incorporate ESG issues into investment analysis and decision-making processes. So ESG means it's the environmental, social, and governance. Right? We'll discuss a bit more about this later. But principle number 2, we will be active owners, incorporate ESG issues into our ownership policies and practices. We'll seek appropriate disclosure on ESG issues by the entities in which we invest. We will promote acceptance and implementation of the principles within the investment industry. We'll work together to enhance our effectiveness in implementing the principles. We'll each report on our activities and progress toward implementing the principles. Right. So the organization signing up for these principles are investment companies, right? So be pension fund and so on. So they're like investors who commit to follow these principles. So more on ESG. So they are divided into environmental, social, and governance issues. Right? So environmental issues include sustainable land use, biodiversity, circular economy, plastics, water, fracking, and methane. Right? So like addressing these factors of pollution. Social issues include labor in the extractive industry, clothing, apparel supply chains, human rights, modern slavery, labor rights, and just transition, diversity, equity, and inclusion. Governance issues cover tax fairness, responsible political engagement, cybersecurity, executive pay, corporate purpose, anti-corruption, whistleblowing, and director nominations, among other things. They are derived from what we call the SDGs, the Sustainable Development Goals that have been defined by the United Nations. And these goals are there are like 17 of them, and you see them in these graphs. I won't go like all of them. They go from like the SDG number 1 would be reducing poverty, what they call like no poverty, to clean water and sanitation would be the SDG number 6, to SDG 16, peace, justice, and strong institutions, and 17, partnerships for the goals. Right. So ESG has created a whole industry of so ESG investors, ESG like rating companies, ESG scoring companies. So here, so the most well-known companies are MSCI, Refinitiv, S&P Global, Sustainalytics, and Bloomberg. Right, so they do scoring and ratings in the ESG land. So ESG scores and ratings, they measure the exposures and resilience of a company, right, to the environmental, social, and governance risk. Right, so how the ESG risk impact these companies. Right. So higher the score on the rating, the less exposed to the risk, and the better a company is at managing this ESG risk and opportunities. So here, for instance, the MSCI. So the ratings start, as you see it in this graph, right? In these tables, from the MSCI scores. So you have like 3 pillars, right? From E, S, and G: environmental, social, and governance, right? And and you see that they're all divided into a list of like 33 issues, right, relevant to the company and its industry or sub-industry, right? And they are themselves divided into 10 themes, right? So you see these green boxes, like climate change to corporate behavior, right? So for instance, under climate change, you see the first column will be, you see carbon emissions, product carbon footprint, financing, environmental impact, climate change, vulnerability. So here, for instance, this is the rating of Microsoft, right? It has a AAA rating, so this is the best rating. So you see, this is inspired from the credit rating, so it goes from a triple C to a AAA. AAA is the best, and triple C is the worst. So Microsoft is has a very good score here. MSCI is not the only one doing this. So here, I won't go into all the details for here, but the company called like Sustain Analytics does something very similar, right? So you see that it's also used like diverse information such as corporate publications, regulatory filings, news, NGO reports, company feedbacks, right, to collect the data on ESG. So they evaluate a management score and a company exposure to ESG risk. So they have 20 material ESG issues, right? So you see it differs slightly from MSCI. And so they start from classifying these companies into sub-industries. They assign the same set of issues, and they can make some adjustment depending on company specific factors, right? And then they can look at like the rest. Right? So then they analyze the E, S, and G, the sub elements, and they score these elements, and they aggregate all these elements. So for instance, here Microsoft has an ESG risk of 15. So it's relatively low risk, right? You see that it goes from 0 to 10, negligible risk. Low is from 10 to 20, and severe risk is 40 plus, right? In that industry group, so Microsoft here is in software and services. It receives a score of 64 out of has a ranking of 64 out of like 1,054 companies, right? And so this might be in the industry, in the global universe, is the ranking is 1462 out of like 15,000 companies. So do you have other like companies you can read more in? So this is also, by the way, the chapter in a book that is going to be published very soon on foundations of AI in finance. Okay. On ESG scoring, some researchers have looked at these ESG scores very closely, and these Professor Berg and his co-authors in a study published in 2022 found that there's some divergence among these ESG ratings, right? So they have been using at that time so 6 prominent ESG rating agencies that you see here, right? You see company called KLD and Sustainalytics, Moody's, S&P, Refinitiv, and MSCI. And they find that the correlation is not that high. I mean, the correlation is only like 0.54 or 0.54. So it's a bit surprising. You would expect maybe if they measure the same thing, that correlation should be high, maybe like 0.8 or 0.9 or 0.99, right? But it's only 0.54, right? So it means that it's quite common for these ESG ratings to be different for the same company, okay? So here I give you an example for Microsoft where the score was also identical across all these ratings, but you can find examples where the scores are different, and they propose like 3 main reasons for the divergence of these ratings. So they can use different sets of criteria to assess ESG performance. So we have seen that in the previous example that it is true. They're not always looking at the same things when they evaluate a company's ESG performance. They use different methods to measure the ESG performance, even if they agree on what they have to measure. So they may use different data sources, methodologies, on the rating scheme. And the weighting, there could be weighting divergence, right? So they have different weights to different ESG factors. As the MSCI, you have like 33, like subcomponents. So it depends a lot on how much weight to put in each component, right? Even if they are equally weighted, But if the one factor is measured with like 10 sub-elements or 5 sub-elements, you see that these weights could be different. Right? Another elements of that conveys ESG information or sustainability information is in the accounting space. Right? So in the accounting space in the US, we have what we call is the gap. So for accounting, so these are like different rules that that the companies have to follow to publish their accounting financial statements. In the international arena, we have what they call IFRS for financial reporting, and there's a standard IFRS S1. So that has been developed recently. That's going to be, I believe, introduced. I think that's something like the next year, in fact, and aims to furnish essential information to financial report users. Financial report users could be investors, financial analysts, lenders, etc. To help their decisions on resource allocations to entities. Right? So the standard emphasizes sustainability related risk and opportunities. And the standard, so IFRS S1, link these factors to an entity's cash flows, stakeholders' interactions, societal impact, economic involvement, and environmental considerations across its value chain. Okay. So the guidelines, though, I'm sure that the usefulness of what they disclose and that the standard applies within the framework that these IFRS sustainability disclosure standards. Right. The big problem for people, for instance, even who want to give a score to ESG, is that if the reporting is not uniform across companies, when the scoring might not be uniform, right? So IFRS S1 is really to give some basic rules so that the companies report the same things. IFRS S2, so another standard, is more focused on climate, right? So it mandates entities to disclose information on climate-related risk. This is really focused on climate, on risks and opportunities that could impact their cash flows, finance access, or cost of capital in the short, medium, or long term. Right? So, for instance, if a company is very exposed to climate risk, and it'll have, for instance, a big impact on the cost of capital, meaning that the risk might be so high that as a borrowing cost or issuing shares can be very costly. This has to be disclosed. So the standard covers physical risk. So it could be that your factories are in a country very exposed, or your factories are on some like small islands, maybe very exposed to climate change, like rising sea level, for instance. So the standard also covers transition risk, opportunities related to climate change, excluding those deemed insignificant. Governance disclosures include details about the responsible body overseeing climate-related aspects, their roles, skills, and considerations of such factors in decision-making. So it could be a climate focus board or some board members. It could be the whole corporate board. Strategy disclosures. So that you have to give insights on how the company is going to address these climate-related factors. Risk management disclosures. So how do you manage the risk, right? And how do you integrate climate risk into your overall risk management processes, right? You have to disclose the metrics on the targets. That will include information on greenhouse gases, transition risk, physical risk, opportunities, capital deployment, ethanol carbon prices, and remuneration with emphasis on industry-specific metrics. So this standard, IFRS S2, encourages the use of climate-related scenario analysis based on reasonable and supportable information available at the reporting dates to assess climate resilience. So IFRS S2. I think that will be mandatory next year too. So ESG, sustainable investment strategies and products. So incorporating ESG considerations into investments can be done many ways. Right? So the first approach is what we call a screening, right? So you screen an investment universe. So for instance, you start with all US stocks, all US publicly traded um, stock, and you either include or exclude companies based on some ESG criteria. ESG criteria could be, something very simple. It could be all the ESG MSCI rating has to be, let's say, single A and above, or single A, double A, triple A, for instance. So here, one of the largest ESG ETF is the Vanguard ESG US Stock ETF. So it tracks ESG index, what they call the FTSE US All Cap Choice Index. So it's a market cap weighted index comprising large, mid and small cap stocks. So it applies a specific ESG criteria and includes stocks from companies involved in various activities, including adult entertainment, alcohol, tobacco, cannabis, gambling, chemical, biological weapons, cluster munitions, etc. Right? So it's excluding companies, right? And, the companies, the index excludes also companies that do not meet labor, human rights, environmental, and anti-corruption standards defined by the UN Global Compact principles, and also includes other companies. Right? So this is how the index is constructed, and the ETF follows the index. Another set of another way to invest are these Calvert principles. So Calvert is a company that very prominent in the sustainable investing. So they look at companies that that follow these principles, right? So here they could briefly they could look at companies that contribute to environmental sustainability and resource efficiency, equitable societies and respect for human rights, accountable governance and transparent operations, right? So here they proactively look for these kind of companies, and then they invest in these companies, right? So this is a different approach. So you screen the universe and you select companies instead of excluding companies. Another approach is active engagement, right? So this is like shareholder advocacy. So what they do typically is they buy a few shares in a company, and they try to influence the corporate board and the management of the company. So shareholder advocacy is a mean to encourage firms to disclose information about their exposure to climate change risk and their risk management strategies. So the many academic studies have documented that it has some effect. I mean, it's not perfect. So here I mentioned a few of them. The last one was the last one, Azar and his co-authors in 2021. Look at the role of major investment firms like BlackRock, Vanguard, and State Street. These are huge investment firms. How successful are they at reducing global carbon emissions? And they find that these companies, because of their size, they tend to engage with firms having high CO2 emissions and larger stakes, and in which they have larger stakes in their portfolio. And over time, there's a growing like negative correlation between the ownerships and carbon emissions. So the more these big three have at stake, and the lower are the carbon emissions, right? So you see that they have an increased focus on environmental issues. You have other studies like such as Flammer and Dias and Rennie. Norges Bank. Norges Bank is one of the largest wealth fund. So it is the fund that manage the all money from for Norway, and this money is used for investment in Norway, pension of the Norwegian, etc. So they also very focused on sustainable investment. So here they so in their investment objective they cite like the responsible management activities. So they aim to establish a chain of measures as part of responsible management efforts. So the responsible management activity should align with the long-term goal of companies in the portfolio to achieve global net zero emissions by the Paris Agreement. That's the Paris Agreement in 2005, so they're quite explicit. They talk about responsible management principles. So the principle should be based on international recognized environmental, social, corporate governance, and climate risk management standards. So you see that it's very explicit. Then they talk about contribution to international standards, exclusion or observation decisions. Right? And you get more details on their website. This is not just bank. So how does AI contribute to sustainable investing? So here, I'll go over three examples. So the first one is from a paper written by Svanberg and co-authors. Their paper is called Corporate Governance Performance Ratings with Machine Learning. Okay. So they train several machine learning classifiers to predict corporate governance controversies from ESG metrics. Right? So they try to assess a company's governance sustainability and develop corporate governance performance metrics. Okay. So what they find is that this method is better than the aggregation that is ESG rating agency use, because it's more like data driven, right? And the aggregation is done by the machine learning models. And because these machine learning models account for non-linearity and more complex interactions, they find a better model. Right? Refinitiv, MSCI, Sustainalytics use more like subjective weighting. Well, that study that I've mentioned from Berg showed that indeed these ESG ratings are a bit can be quite different. Right? So to do their test. They use data from Refinitiv, like on over like 2,500 companies from 2009 to 2018, and they identify 114 corporate governance data and governance controversies that I think they find from public news. And they look at performance metrics used in machine learning classifier models, precision, recall, etc. And they compare their models with the standard ESG ratings. They test. So here, going more into details. So they test like 9 different models that are standard for machine learning: nearest neighbors, super vector machines, random forest, logistic regression, artificial neural network, gradient boosting, naive Bayes, and quadratically discriminant analysis. Okay. They evaluate the models using tenfold cross validation. So tenfold cross validation means that they they divide the data set into like 10 buckets. They train the model on 9 buckets. So these buckets are non-overlapping, of course. And they test the model on the 10th bucket. Right? There's a typo here. So you have a tenfold cross-validation, 10 buckets. You train the model of 90% of the data, and you test the model on the 10% remaining. So they find that random forest, neural network, and gradient boosting have the highest precisions on area under the curve. So they are the best performing models, right? They tend to be true for in the classical machine learning. These gradient boosting, random forests tend to do very well, and of course neural networks too. Okay. Another interesting studies, that one is called hedging climate change news. Okay, so here Engel and his co-authors they look for trading strategies to hedge portfolios. So you have a portfolio. So it could be Norges Bank, and it could be BlackRock, or it could be Vanguard. You have a portfolio, and you want to hedge your portfolio against climate change risk. And they use climate change news as a proxy. Okay, so what they do, they gather climate news from the Wall Street Journal, and they create climate risk factors and indices based on this information. So to hedge against these factors, they propose two approaches. So the first one, they track stock reactions to climate news to build a portfolios that go long on stocks that outperform, on short on stocks that underperform, with an increase in climate news. Okay. The second approach is to build portfolios that mimic climate risk factor for hedging. So to extract these factors, so the Wall Street Journal is a newspaper, of course, so everything is in text, right? So what they do, they extract word counts, and they employ what they call like TD-IDFs. So these are term frequency inverse document frequency. And they repeat, so this is to identify like keywords that matters for climate risk. So they repeat this analysis with 19 authoritative texts on climate change policy. So it could be something like the Stern report on climate change, or UN reports, official reports from the international or US agencies. And they use 55 climate change glossaries from various sources. So the TD-IDF, what we call it, the term frequency inverse document frequency, are these reference texts on the cosine similarity between the Wall Street Journal and climate change sources, are then calculated to establish a climate risk index. Right? So the more climate change news published by the Wall Street Journal, the higher the climate change risk index. Okay. Additionally, the researchers compare the index with the climate negative news index provided by a company called Crexam Hexagon, just to validate the model. So here I go into some details, but you can read more about it in the paper. So they use the climate characteristics, right, extracted from the text. The MSCI Sustainalytics scores to weight or rank the stocks, right, cross-sectionally, right? So the stocks very exposed or not exposed. So these scores are components of the ESG scores produced by the EE scores. So the E from ESG, the E from ESG was environmental. They ignore the S and the G. Comes from the ESG scores from these rating agencies. The characteristics are used to run a regression of climate change index on stock returns, right? And dependent variables is the innovation in climate change news. right? So there's a residual of an autoregressive regression. So just like this is what we call innovation, the change in the climate change news that you regress on the characteristics and the stock returns, right? They also add factors that we use in academic finance, a lot of size, gross value, and market factors in the regression, so to cover all the factor returns. Right, so this is the regression that you see here. So the same equation, but you add the size, value factors on the size factors. So what they find that the system analytics E-score give the highest R squared, right? So the best fit in the regression for the absolute and relative score. And that they find that the most example results that out of sample, the portfolio is constructed with the sustainability e-scores have a correlation of 17% or 21%, depending on the scores, absolute or relative, with the Wall Street Journal Climate Change Index. Okay. And let's go. Over. So the previous paper, just to conclude, so this is a way to identify stocks exposed or not exposed to less exposed to climate change, and they build portfolios, long short portfolios that can hedge against these the climate change risk, right? From that they measure from the Wall Street Journal. The last study is done from Professor Serafin from Harvard Business School. So the paper is called Machine Learning Models for Prediction of Scope 3 Carbon Emissions. Right. So we haven't gone through this, but so you need to know that the greenhouse gas protocol. So when you are focusing on reducing CO2 emissions for companies, they define like 3 scopes, like scope 1, scope 2, and scope 3. So when you think about the company, how much CO2 they emit, right? There are different ways they can emit CO2. So scope 1 is direct operations. So from your direct operations, for example, you run from factories, and you burn oil, you burn use some materials, a chemical process, for instance. Let's say, I'll give you an example. You produce fertilizer, right? So in the process of producing fertilizers, the chemical process, you are going to produce a greenhouse gas. Okay, so this is the direct emission. It should be accounted into a scope 1. Okay. Scope 2 is the CO2 emissions from your energy consumption. So you don't emit CO2 directly, but your electricity consumption, because the electricity consumption comes from somewhere else, that use a power plant, right, to produce the electricity. So that power plant could be can use coal, natural gas, or something that will emit the CO2. So this has been accounted for because you are indirectly responsible for these greenhouse gas emissions. This is what they call scope 2. So it goes like beyond your direct operations, we call scope 2. Scope 3 is also indirect, like scope 2. So this comes from the value chain, right? Upstream or downstream, so coming from your suppliers or your customers, right? So this is like a thing that you see this in that graph. Scope 1 to be direct, right? Coming from your company vehicles, your trucks, your facilities, your factories. Scope 2 is your energy consumption. On scope 3 indirect, divided into two. So it comes from your suppliers. So it could be purchased goods and services, right? So even if you're doing only assembly, right? But the components you're assembling must have emitted the CO2, and your suppliers have emitted CO2 or greenhouse gas on your behalf. So this has to be accounted for, right? Business travel, right? So for instance, if you are, even if you don't directly emit greenhouse gas, let's say you are like consulting companies, but your consultants fly all over the world to meet their clients and to do their work. So they're going to do a lot of business travel. So they're going to fly, and these planes are going to emit greenhouse gas. Okay. Even if they don't travel very far, even commuting, if your employees are commuting, they're driving, to come to your office, these are like scope 2 emissions that you have to account for. So these are like the upstream emissions. And downstream emissions is so when you have produced the goods and services, there are emissions indirectly caused by what you produce. So you see in the graph, so it could be a transportation and distribution, right? So you produce the goods out of the factory, but these goods have to be transported to for instance, the retailers or to your customers. It can be very far away. It has to be shipped, or it can be transported by planes and trains, etc. Or these your goods might have to be transformed further. And so all these things have to be accounted into downstream scope 3 emissions. But you see the difficulty that scope 1 is relatively easy to measure. Scope 2 should be also possible, right? If you ask the companies to disclose their energy consumption. Right? So you could have an idea of scope 1 and scope 2. Scope 3 is quite difficult, right? Because there's so many things involved, right? So you need to know, for instance, if a company, you see how much let's say how much capital goods and services the company is purchasing, and then how much of greenhouse gas emission they have emitted. Right? So you have to go look at the suppliers and see in their own process. Right? So you have to look at you have to look at the scope 1 of this of the suppliers to calculate the scope 3 of the given company. So to do that, you can use machine learning. And so Serafine and his co-author, they use predictors. So they try to predict the scope 3 score. And they include industry country information, accounting and financial variables, emission metrics for scope 1 and scope 2, right? Because there's correlation. You see that before IFRS, we saw like IFRS S1, S2, you had what they call a carbon disclosure projects, a CDP, where companies like voluntarily disclose scope 1 and scope 2 emissions. So Seraphim has information from the CDP. They use other variables on logarithmic transformation of these variables, such as total assets, net property, plant and equipment, common equity, etc. So these are accounting variables, and emission metrics from scope 1 and scope 2 to build and try to proxy scope 3. So the scope 3 encompasses 15 categories. Business travel, purchase goods, fuel and energy, waste generated in operations, employee commuting, etc. So they use two supervised machine learning models, random forest and AdaBoost, like a boosting model. And they compare with benchmark models using linear regression and KNN, K nearest neighbors. So it means that they have data on the scope 3, right? So they have to, this is like supervised learning, so it means that they have models with the right labels. So they train on 80% of the data, and they test on 20% of the remaining data, right? And they find that these random forest and boosting models perform the best. The model called AdaBoost has the highest accuracy in predicting scope 3 emissions comparing to other models. Okay. In terms of features, so what can explain scope 3, defined as scope 1 emissions, a number of employees, scope 2 emissions, so it means that your direct emissions plus emissions from energy consumption, inventory turnover, SGA expenses, and the most important predictors are scope 3 emissions. Okay, so this is very important. Like you don't have scope 3 data because not many companies that disclose scope 3 data. So this can be used as a potential proxy and incorporated into investment model. This is something else. So quickly, just to conclude. So AI can be used for sustainable investing. So you have seen that that ESG by itself has been a subject that is a bit not say arbitrary, but the methodology is a bit can be a bit different, right, across rating agencies. So you can use AI to find something a bit more like formalized and data driven, right, less subjective, to build the scores. You can use AI on capabilities in natural language processing to extract climate change data from news, right, using text. On the third example, you can use AI to try to approximate scores that you don't observe, right? Like scope 3 emissions. So this can be used for investors or for people who are interested in ESG issues. And I think that AI can help a lot. This is like a big area of development on research. Okay. So